Welcome to Politics in Your Portfolio. My name is Nick Hughes. I'm a certified financial planner and investment advisor representative with Visionary Horizons. What that means for you is that I can provide financial planning and investment advice for a fee. The opinions expressed today are my own, and please consult with your own tax and financial professional. This should not be construed as specific financial advice for anyone. We're going to look back on returns over various markets the last 1, 5, and 10 years. And the last 12 months have been pretty good across the board, where US stocks have led the way. They averaged over the last 12 months. We've seen returns over 20%. The international market's not quite as good, but in the low double digits there. Global real estate started to come back, and we started to see bonds act more like bonds with returns in the low to mid single digits. Over the last 5 years, you can see a similar pattern where US stocks have outperformed most other asset classes, and bonds have really been a headwind, driven primarily from the fact that we've had global inflation across the globe due to the pandemic and other policies that have been put into place. We've seen a really inflationary environment, and the approach that governments have taken to combat inflation has primarily been through central banks raising interest rates. And by doing that, that's not been very good for bond returns, as you can see. Over the last 10 years, US stocks, again, the winner. International emerging markets in the low single digits here. You are getting a positive return from both US and global bonds over the last 10 years. Here in the US, it's really been a story of just a handful of companies that have been driving the returns in the S&P 500. And they've been referred to as what's called the Magnificent Seven. But you can see 2022 and 2023 were a tale of two different stories. 2022, as the Fed was raising interest rates, and a lot of in the tech sector were really they were reducing their staffing and employment, cutting their expenditures. And 2023, you saw that a lot of these companies, because of those maneuvers that they made, were actually beating analysts' expectations, and they had a banner year. So you had those things that happened, and the Magnificent Seven really bounced back in a big way in 2023, and a lot of that drove the returns that we saw in the market. The S&P 500 had a good year, but just the seven companies in the Magnificent Seven averaged over 100%. 111% was the average return for Magnificent Seven stocks in 2023. So they did well. You know, that Magnificent Seven, that name is very fitting given what the recent returns have been. But Wes Krill of Dimensional Fund Advisors thinks that investors may not want to be expecting those types of returns going forward. In fact, when we see these companies that become an outsized share of the S&P 500, generally over the next 5, 10, 15, 20 years, they don't perform nearly as well. So you may want to consider not emphasizing those companies as much in your investment strategy. I'm going to talk a little bit about investing in an election year. So here's a few things to take away from this. Number one, it's really difficult to identify any patterns that occur in election years. So if a Democrat gets elected, if a Republican gets elected, there's not a lot of evidence that shows that investing in a particular way is really going to benefit you based on who's in the White House. Also, market returns have been positive both in election years and the year right before the election, market expectations tend to be priced into where the market is right now. The market is forward looking. So it is essentially taking every investor's expectations and it's reflected in where stock prices are, essentially. So if you look at this is 100 years of stock returns. So these are monthly stock returns. And the blue and red lines represent months when Democrats would be blue. Red would be when Republicans won the White House in a presidential election year. And as you can see, there's a lot of randomness. It's kind of all across the board in terms of what you can expect. And what I would take away from this is that you really can't, there's not a reliable pattern that we can look at to say that we should be investing in a particular way based on who's going to win the White House. So as you can see, the long-term return of the S&P 500 has been about 10%. But if you look at the year subsequent to a election year, it's been above the long-term average. But if you invest during an election year, it's been almost 1.5% above. So the fact that returns have been so strong in these years around an election means you don't really want to sit things out. You can still experience strong returns as a long-term investor. And over time, it doesn't really matter, what party's in the White House. You can see that the market does what it does. It's been a great way for investors to compound wealth over time. We've had 2 Democratic presidents. We've had a Republican president over the last 15 or so years, and the market's done incredibly well during that time period. Now, there have been periods of time when the market hasn't done quite as well, but it's difficult to say that it's based upon the president. I think that we give presidents far too much credit when things are going right, but we also give them too much blame when things are not going well. Same thing for Congress. We've seen a similar situation here. You can see that regardless of if you've got Democratic control, Republican control, or you got a mixed Congress, the market has performed pretty well over time. One thing that we can take away around elections, just because of all the uncertainty there, I mean, you've got a situation, it's not just is Donald Trump going to win, is Kamala Harris going to win, but if either of those 2 candidates win, you also have a situation of what's Congress going to look like. So you could have Trump win the White House and we have a Democratic Congress and vice versa. So those types of situations are really bringing even more uncertainty into this election cycle. So one thing that you can see is that particularly over recent history, we've seen a big spike in volatility in the months leading up to the election. And one way that you can measure volatility is essentially just uncertainty in the market. So the swings that we see in stock prices reflect that uncertainty. And so as we see more uncertainty, we tend to see what's called the VIX index or the volatility index tick up, and it has generally been the highest in October, the very month before November, which is when we vote. Things tend to start heading back down in the months after the election. But this is something that's been pretty reliable, is that we'll have more volatility tied to the uncertainty here in an election year. As you can see, This is 100 years, give or take, of presidential history here. And basically, what we've had is we've had about 24 presidential terms, and during most of the presidential terms, we've had recessions of some type. So we've had, I think there were only about six, maybe seven presidential terms where they didn't have a recession, but we've had about 1 out of 4 election years we actually experienced a recession during the election year. Most recently in 2020, during the COVID pandemic, we did have a recession. I know that was a very unusual recession. It went down very sharply, the economy and the stock market, and it recovered very quickly. Due in uh, large part because of the spending and the government stimulus that we did, and also with the Fed lowering interest rates. I mean, we lowered interest rates to basically zero, but you can see that over a presidential term, a lot of presidents do experience some type of a recession, particularly if they're a two-term president, because we generally have a recession about every 6 to 7 years. We work with a lot of retirees that are in their early to mid 60s, and they're going to need their money to last another 20, 25, 30 years in a lot of cases. And what I like to tell people is that over that period of time, you're probably going to live through another 3, maybe 4 recessions. So you need a portfolio that's going to be resilient and do well during good times, but also hold up during bad times as well. Now, a lot of people believe that when there is a lot of legislation getting passed through, that it could either be good or not good for the economy. And in fact, when we look at this, you can see in this bar graph right here, the larger bars are when we've had more bills that have been passed in Congress. And what we've seen over time is that gradually it seems like Congress has been doing less and less in terms of just passing a lot of big legislation. But the yellow dots represent what the S&P 500 return has been, and there's not a lot of relationship here to say that when there's a lot of legislation getting passed, returns are good, or if there's not a lot of bills getting passed, returns are good. You really can't connect the two here. So one thing I would say is, regardless, policies do affect things, but you can't necessarily just look at the volume or lack of volume and say that that's going to impact the markets in one way or another. Presidential approval ratings are also can be misleading if you're trying to guess about stock returns. Now, you don't necessarily want really, really bad presidential approval ratings, because that could mean we're in a really deep recession. It could mean we're in a depression of some type. But what you want is maybe low to medium approval ratings, as shown here. We don't have as much data here. We've got data going back to the early 60s, but you can see that when we've got medium approval ratings, we tend to have higher stock returns than when we've got really high approval ratings. A lot of times, the way you could think of this is, when you've got high approval ratings, it could mean a lot of the good news has already been baked in. If we're real happy with the president, maybe a lot of the good economic times have occurred. That's reflected in the stock market, so returns may not be as good going forward. When things aren't necessarily rosy, we could have better times ahead, and that could mean You've got lower approval ratings, but you have higher potential returns from stocks in those scenarios. Now, I know another concern of folks is that we're in a very divided time. There's a lot of polarization in our country. There's a lot of rhetoric out there that's very harsh. And if you look back at our history, it's not really unprecedented that we've seen this type of thing. In fact, two of our founding fathers really questioned what was being written about them in the newspapers, both with George Washington and Thomas Jefferson. We even saw a very um, vitriolic situation with Alexander Hamilton, who is the former Treasury Secretary, and Aaron Burr, who had a duel. And Aaron Burr shot Alexander Hamilton, not fatally, but he ended up passing away from that due to this. So we've seen times that have been, not necessarily very harmonious in the past, and we've seen these bitter rivals in politics before, and harsh words before, and we've come through to better times. So don't think that we haven't seen this before. In fact, we have. One thing I would say very strongly is hating the government is not an investment strategy. Now, if your team doesn't win in November, you don't want to necessarily add insult to injury and sit things out for the next 4 years. I've seen it happen both with Democrats and Republicans, and what you often see is that, if this person gets in office, then I think the stock market's going to crash. You may be invested a lot more conservatively than you otherwise would be, but you could miss out on good returns. We just don't know what's going to happen. So you should really have your portfolio to reflect your goals rather than if this side wins or if this side wins. During times of uncertainty, diversification is your buddy without question. And one of the things that I think is a misconception about diversification is you may think that if I'm diversified, I may not have as good a returns over time. Well, in fact, the opposite can be true. Instead of trying to pick a needle in a haystack, sometimes it's just better to own the haystack. And as you can see, this is the MSCI All Country World Index. And if you just own all the stocks in the index, you've gotten about an 11% return over the last 14 years. If you excluded just the top 10 contributors, so the 10 stocks that did the very best in that index, you didn't own them, then your returns were almost 3% less. If you excluded the top 25 contributors, then your returns were almost 4% less. So as you can see, diversification can actually really work in your favor. Throughout history, we've had a lot of reasons to not invest. We've had a lot of scary things going on. We've had missile crises. We've had attacks on U.S. soil. We've had the COVID-19 pandemic. But even though there's been turbulence in the markets throughout history, one thing that's persisted on is we want to do better. Humans are very good at making things better and solving our own problems. That's why capitalism works. And as you can see, if you stay invested over time, you tend to do pretty well. We've seen a dollar turn into about $99 since 1970 if you just stay invested over time. Now, here's a quote from Mark Twain, and I think it's very fitting. You know, we've got the media in our face all the time, especially in an election year when they know people feel very strongly both ways. You know, some people may think, you know, their country's being taken from them. Some people may think that they may not have a country if one candidate wins versus the other. But one thing we can take away from this, you know, Mark Twain once said, I've lived through some terrible things in my life, some of which actually happen. It's usually not the things that we're really worried about that end up hurting us. It's usually the things that we're not as concerned about. Maybe we're a little bit complacent. We may be overconfident in certain areas, and those can be the things that ultimately work against us. So you don't necessarily need to just be only focused on those things that you're most worried about and are most our attention is most drawn to at any given moment. When it comes to changes in the government, you know, things that we can see impacted can be tax rates and the tax code. So we're going to go through some tax strategies here that you might want to be considering. So we're in a pretty advantageous time right now. We don't know how long it's going to last. We do know that if nothing changes, the Tax Cuts and Jobs Act, which was enacted in 2017, is set to expire at the end of 2025. So we've got less than 2 years now that we have pretty good certainty that we're going to have favorable tax rates for individuals and estate tax rates. So if we're looking at the estate tax exemptions, essentially what the estate tax exemption is for individuals, you can exempt a certain amount of your estate from estate taxes. And so for 2024, that is approaching, you know, it's a little bit less than 14 million. But if you're married, you can double that. So it can be over 26 million. But I know this isn't going to impact everybody, but it's something you may want to be thinking about it if you have, let's say you own a business, or maybe you've got multiple businesses, you have a lot of real estate, you have 401ks, maybe you have insurance that you own in your name as well. You can have a relatively large estate. And if you live a long time, it can grow even more. So estate taxes, particularly if the estate tax exemption amount is allowed to reset at the end of 2025, we could see the estate tax exemption go down to below 8 million. So if we've gotten real comfortable with a $13 million estate tax exemption, and here in a couple of years it goes down to 8 million, we could see more and more people coming in the crosshairs and having estate taxes. Again, this isn't going to affect everybody, but something to consider for some people watching this. So if we look at how the Tax Cuts and Jobs Act affected individuals, we're going to focus primarily on married couples here, but you can see we had several different tax rates prior to the Tax Cuts and Jobs Act. So they still started at about 10%. The next bracket above was 15%. Then it went to 25%, 28, 33. But one of the key things you can see is that here we are where tax rates are lower. So if you're in the 12% bracket today, there's a possibility that if these tax rates expire at the end of 2025, that you're now in the 15% bracket. So that's about a 3% 3 percentage points that's added to your marginal tax rate. Same thing. If you're in the 22% bracket, you could go to the 25%. One thing that makes this a little bit hairier is that there are folks that are in the 22% bracket currently that if rates expire could be in the 28% bracket. And also you see people in the 24% bracket that could see themselves fall in the 33% bracket. So basically what happened is uh, the tax brackets were a little bit were more narrow under the old laws than they are now. So this is something that you want to consider. This could be a very advantageous time to look at realizing some income if you think that your tax rates could be going up in the future. So as you can see, so this is what would happen if the tax rates are allowed to expire. You've got the blue line, which is where tax rates are currently, but the orange line is where they would be if rates are allowed to expire. So almost across the board for married couples, there is a small percentage of folks that may actually see their marginal rate go down if rates are allowed to expire. But for most of us, you would see your tax rates going up if these rates expire at the end of 2025. One of the ways that you can try to take advantage of this time is looking more closely at Roth conversions. Now, I don't want to oversell Roth conversions for folks. I think there's a lot of people pounding the table about Roth conversions. They can make sense. It's not an all or nothing thing. So if you have, let's say you've got $500,000 in an IRA, you don't have to convert that entire IRA in 1 year. In fact, it's generally better to do it over a series of years. In this case study with Ted and Lisa Smith, now this is an actual financial planning situation, but we've changed the names to protect the innocent, if you will. Here, what we're showing is that in the case of Ted and Lisa, they were a younger retired couple, and they retired from work, but we're still working a little bit. And so because their income had gone down, we were trying to maximize the amount of income that they had so that they filled up the 22% bracket. So they stayed in the 22% bracket. They converted enough of their IRAs and 401ks so that they stayed in the 22% bracket and did not go over that. And by doing that over a series of years, they could effectively convert all of their IRAs and 401ks to Roth. Now, they are realizing income in the year they make that conversion, but even though they're going ahead and voluntarily paying the federal income tax, by utilizing these strategies, we're projecting that they could save themselves over $135,000 in their lifetime tax bill. So that's the number one thing you want to be looking at. Does it benefit you, or is it likely to benefit you, should I say, during your lifetime? That's number one. This is a long-term strategy. As you can see, the red bars represent the years where they're paying more in taxes. The green bars represent the years that they're actually showing tax savings. So if you expect to live a long time, it can be a very beneficial strategy for you. Second to that, it can be very beneficial from an estate planning perspective. You know, one of the objectives of estate planning is transferring as much of your wealth to the next generation as possible. Or maybe you like your grandkids better, you're trying to skip a generation even. But by converting assets to Roth, Roths have some benefits in that, number one, there have been some changes with IRAs and 401ks when you inherit them. So since the Secure Act in 2020, there's now a 10-year rule. And essentially what the 10-year rule states is that if you inherit an IRA or a 401k and you're not a spouse, then you have to deplete that in no less than 10 years from the year that that person passed away. So as someone that's inheriting an IRA, if I'm inheriting a pre-tax IRA, I'm having to deplete that over 10 years. Now, I could take, they did clarify that if the decedent or who owned the IRA originally was already taking required distributions, then the inheritor that's a non-spouse would also be forced to take required minimum distributions. They clarified that it was a little bit uncertain as far as what the law had intended, but they did clarify that a couple of years ago. They've given people a reprieve for 2024 and previous years, but it's looking like in 2025 you will have to take required distributions. So not only may you have required distributions, you have to deplete that within 10 years. Now, when you think of folks that could be inheriting these monies, they could be, number one, tax rates could be a lot higher for one. Number two, if your kids are inheriting your assets and they're in their peak earning years, their tax rates could be much higher. And now you're also forcing this additional income from IRAs that they're inheriting, and it leaves less of your IRA actually going to them because they're paying more in taxes. But by converting that money to Roths, if they're inheriting a Roth, number one, you don't have required minimum distributions for a Roth IRA other than you have to pull that money out within 10 years. Now, you could leave it in there for 10 years and pull it out tax-free in the 10 years. And if you do that, you could see a substantial amount of growth. If you're only earning about 7% on that money, you could see your money double over that 10-year period. So it can be a very powerful wealth transfer strategy to look at converting even a portion of your IRA to a Roth to leave to your kids or grandkids. We've covered a lot. I'm sure you have some questions. We encourage you to reach out. Feel free to give us shoot us an email, call. If there's any questions that you have about how this might apply to your circumstances. Thank you for joining us. We enjoy doing these types of things. If you enjoy this type of content, please like and follow our YouTube page. And don't forget to get out the vote. November 5th will be here before we know it. Take care. We'll talk to you soon.